right. We'll go live on our Facebook channel as well. So welcome everyone to the Real Estate Mastermind. And we have an amazing guest on here today with Chris Griffith. And but first, let me get started with a few announcements. This meeting is not a solicitation for any specific deal. It's not legal or financial advice. Simply professional sharing what we do. And before we get started, our speaker for next week is Nick DeLoyne, also a professional real estate apartment syndicator in the Dallas area. Today, Chris will be sharing with us how to identify emerging real estate markets, and I'll introduce him in just a moment. A little bit about what we do here at Eagle City Multifamily is we purchase apartments and we open these deals up to individual investors like you and I. And you can invest directly in real estate, and it's different than REITs. In case you've heard of REITs, where a real estate investment trust is more like a mutual fund, where the syndications that we do, every investor is a direct owner in each apartment deal. You can drive to it, you can look at it, you can see how the progress is going by investing in a physical property. So a little bit about our team here at Eagle City Multifamily. Asif Kumar and Nikki and Dr. Sanjeev are also part of the team. And let's jump right on in here. I will introduce our amazing guest speaker today, Chris Griffith. Chris Griffith's experience range from single-family residence to large-scale commercial asset acquisitions. With a knack for finding mortgage solutions, he specializes in working with veterans of the armed services and VA loans. Christopher believes in solving problems based solely on the needs and motivations of his clients. He delivers on the promise by having the most options to choose from when working in real estate finance. Welcome, Chris. Take it away. Open it up for questions as you feel free.
Perfect. Thanks for having me, Herb. Thank y'all for those that are attending and those that are happen to be watching this live. I'm pretty easy to find if you have any questions after I'm kind of done talking, or later even, and you want to hit me up on social, or maybe run your questions through Herb and send it over. Herb and I met at a real estate investment conference about, what was it, like 3 weeks ago, Herb?
Yeah.
Something like that, 3 weeks ago, something like that. And the guy that puts, Brandon Wong, that puts on that conference, I've known for a few years now from social media. I would say the one commonality in all of my real estate investing has been trying to capitalize on the market. At the end of the day, you can make great investments in a bad market and lose your tail. You can make not so awesome investments in an amazing markets and look like an incredible, like awesome, smart winner that makes all of the best picks. And the reality is a rising tide lifts all boats. So fundamentally, the thing I hope all of you understand is we don't make markets, we observe them and we participate in them. But at the end of the day, consensus and mass consensus at scale determines where a market goes and how far it'll go. And so my goal has been to look at markets that are growing, markets that are evolving, emerging, whatever you want to use, and understand really what their order of operations look like. What are the first indicators that tell me that a market is getting ready to emerge and do something that's really different from what's always occurred there previously, right? And there are a lot of different things you can look at. My background, just so y'all know, I have some single family investment portfolios that revolve around buying REOs from the VA. I've created and been a part of a lease option solution company for about a decade now. I've acquired a apartment complexes, the largest of which a 232 unit multifamily property. I've bought land and learned to cash flow raw land using really strong debt instruments, cattle, water sales to natural gas resource companies, building a slaughterhouse now to further power that land play piece that I'm working on. My goal is to have 50,000 acres or so, 10,000 acres or so by the time I'm 45. We'll see how big that story gets. I'm 37, 38 this summer. We're building an RV park, a 200 unit, 34 acre RV park that'll have tiny homes on it. So I think the best way to describe me is I'm a very eclectic investor. I like to see things a little bit sooner than everybody else does. And I like to get in front of them and hopefully capitalize on what is likely to be mass migration to certain areas, certain geographic areas, which in real estate moves because of local fundamentals. It's not some national market. 2008 to 2010, 2005 to 2010 led a lot of people to believe that real estate operates in some national cycle. When the reality is, did you know there are markets that grew from 2008 to 2010?
Oh,
Single
wow.
family real estate markets. Look up Temecula, California. Check out that market. There are lots of different markets that grew because of local strong fundamentals that were already occurring and driving growth to an area, even when the entirety of the U.S. housing market was experiencing the largest recession that it ever has, right? The largest loss of value. And so for me, when I got out of the military in 2011, like December, I'd already been understanding and following and studying real estate because I grew up a framer's son. My dad still builds homes to this day. He's a framer. And I wanted to understand what makes it all tick. How do all these people buy these stupid houses that we could never afford, right? Because we were broke. For the longest time, we were broke. And so that led me on a journey. It led me down a path of trying to understand it. I attended a few conferences, like many of y'all probably have. I read a book called Emerging Real Estate Markets by a guy named David Lindahl that really challenged my understanding and provided some structure to the order of operations for markets that were experiencing growth. And I set out to try to capitalize on the things that I could see around me or in certain markets that I followed really well so that I would be able to get ahead of the growth and gain. Like that's the game. That's what we all want, right? You're investing in real estate not only for cash flow, but you hope to have very large equity gains. Well, my story was very similar. And so in 2011, I think we started out with attended a conference, read a few books, talked to a bunch of people, and we were going to buy a 100+ unit apartment complex, right? I mean, that's how a lot of people set out, right? But at the same time, you have the doubt, the disbelief, the unbelief, the am I in over my head? What am I going to do if I get something actually on the line here? How am I going to get it closed, even if I find a great deal? At that time, think back to circa 2011, 2012, most apartment investors were focused on your A-plus markets, your large markets that were getting ready to go through a big period of growth. Just the same, so were we. We were underwriting a lot of deals in Dallas and Phoenix and Nashville and a lot of these big markets where population centers had traditionally remained. The problem that I ran into is, have you ever heard not to fall in love with a deal?
Yes.
Most people underwriting deals, it was like, man, they were trying to figure out ways to make it work. And for me, that was a problem because one miss at that point in my investment career would have been catastrophic and would have caused me a decade worth of loss that would have been hard to gain back from. So I wasn't emotional about any of it, though I would say I would characterize myself as an emotional guy. And we started underwriting a lot of apartment deals. I probably underwrote, and I'm not exaggerating here, probably 100 different apartment deals in the Dallas metro area. I knew a lot of the apartment investors that were down there, some of which I had very close relationships with. And I'd ask them, hey, can I see your underwriting on this deal? And then I would compare it to ours. And what I found was, wow, people were really wanting to buy on pro forma. It wasn't that the Dallas market wasn't going to grow, but would they have the means to persist and exist in that market while it went through those kind of long growth pains? Most of us think emerging markets or the time to invest is very short, and it somewhat is. But at the same time, my problem is I'm usually 3 to 4 years ahead of where I think I'm at. And it took me probably a decade to learn that, because I see things a little sooner. And if I'm not careful, I can get into a situation where I don't have the capacity to sustain the investment that I've made to the point at which I'm measuring it. And so the emotional underwriting investment that was going on at that point in time caused me to take a hard look at market demographics. Rather than, it's like if you're walking down the trail with a bunch of people and you have to live off of everything that you find on that trail, and you're number 37 in a line of 100 people on that same singular trail, how hungry do you think you're going to be?
Yeah.
So I had to think differently, first of all. And in 2011, it was probably 2011, sometime middle of 2011, we shifted up our strategy and we said, okay, outside of these A+ markets, what are the population trends looking like? What's likely to occur in some of the adjacent markets to the secondary, those large markets, the smaller secondary markets, and which ones are really poised for growth? Well, to understand that, you have to understand a lot of fundamentals. You have to understand things about people movement. You have to understand things about corporate movement and jobs. You have to understand things about infrastructure issues, geographic issues, corridors of travel. Like all of these different pieces feed into the narrative of, is this market going to grow and how quickly is it going to grow? And so we started to look at what were really B+, I would say rural markets, suburban, maybe leaning rural, probably more rural than suburban even, markets that were well placed to large population centers where if you, excuse me, if you've never followed it, the growth cycle is always predictable. Big market grows, it hits affordability cap, and then people move out. Suburban sprawl, you've heard that term? Well, I think the first time I did a Facebook Live talking about the coming exodus to California was honestly probably 2016, 2017. It was way too soon. I still knew it was going to occur, but I got laughed at by a lot of people because I said California was going to struggle with a population loss because people were going to be leaving it due to affordability issues and a lot of other things that were just encroaching on what humans like to have when they live somewhere, right? Well, if you've been following along at any point in time, they actually lost a congressional seat. They've lost so much population. They've still had people moving in, but at the same time, overall, they've had a net loss of population, which is one of the first times in a long time. If you look at the trends nationally now, you'll see even for the first time in U.S. history, population trends are trending to the south and to non-coastal, non-urban center type cities. All of this stuff is very intriguing because if you can understand where people are going to go, and if they happen to be going to an area that's incredibly small, then pound for pound, the growth that's going to occur in that market is going to be phenomenal. Because at the end of the day, supply and demand fundamentals rule everything, right? If there's not enough supply and there's a whole lot of demand, what happens to prices? Y'all are single family investors. I'm following the chat too. If some of y'all can just basically type out a background of what you like to invest in, what your history of investing, give me a synopsis of who you are as an investor. That'll help me maybe speak directly to a few of you, which I would love to do. But so in 2011, LoopNet's where I found my first apartment deal of all places, right? So you can't find great deals on there. Well, I disagree. You can. We found an apartment that was overpriced and we ended up buying it for a little less than $2 million of what they had it listed for. We bought it for $6.7 million. And today, a little over a decade later, it's probably worth around 18, maybe 20 million. We had to rehab the property itself. We had to rehab the tenant base. After you rehab all of those things, it takes probably 18 to 24 months for the market to reflect the work that you've done, right? So that the sentiment about the property changes. But it's been an incredible adventure. And so we bought that place in 2012. And it was, I would say the first 3 years, it was pretty challenging because there were a lot of things that we anticipated that were absolutely what we anticipated. But the acquisition market being what it was, we still had to pay what we had to pay. And so if anything, I probably could have raised a little bit more money at that time. But as far as what I was seeing in the market that I am in, and I'm going to speak to some specific markets, so maybe you can look them up and try to understand and follow some of the things that have occurred and apply them to the areas you're in. But here's what I saw. If you've ever seen two MSAs, metropolitan statistical areas, grow together, the big market doesn't just grow until it reaches the little market and then the little market starts growing. The big market grows, it hits affordability cap issues, and then the growth jumps. And the little market grows pound for pound in a really cool and amazing way. And so rather than looking in a lot of the markets that everyone else was, the larger markets, we look just on the outskirts of those. I'm in North Texas here, a tiny town called Pottsboro. It's in the Sherman-Denison MSA. Texas has 26 MSAs. Sherman-Dennison's probably by population maybe 22 or 23. But I'd read some studies from people that I didn't understand just yet. Texas A&M puts out a real estate study every year that said that this market was going to be poised for number 5th or 6th or 7th by percentage-based population growth. And so what was going to change that would cause all of that? Well, there was a lot going on. One, its adjacency to the Dallas market and its size comparatively were such that even if a percent of the market adjusted and moved to where we are, our market was going to grow by 30%, 40%, massive numbers, right? And we're an hour, maybe north, 45 minutes north of the DFW market. Or less than that if you've recognized where it's grown through Frisco and Salina and some of those other places. But we wanted to target a market where we could still acquire property at a reasonable figure where we knew it was going to grow. So how do we know it was going to grow? Well, that's a great question. There were a lot of things going on. We have one of the oldest schools, private colleges. It's the oldest charter in Texas with Austin College. There are a lot of other small colleges in the area as well. So there's a strong education kind of priority towards the overall population. So you had a well-educated local population. We had some very strong avenues or corridors, basically, of movement. You have Highway 75, you have 289, you have 35 that all kind of run up out of the Dallas markets up north. Further, you had a planned corridor, which is still being developed now. It's up to maybe 380, and the side roads go further than that, all the way past Gunner now. But the Dallas North Tollway, it's actually planned to come through my town of Pottsboro. And there's not a time frame on it just yet because they're working out. But my best bet is that it's within 6 or 7 years or maybe less of where we're at today. And so you had all of these avenues and corridors for growth that were growing that would allow for population to traverse and live in one market and possibly work in another. And you have some other weird stuff going on. Uber, right? Y'all are familiar with that company. Elevate is the name of the company. Uber Air, which is what it started as, where they're going to use UAVs and basically drones to move people from one place to the next. It's supposed to be like an Uber air taxi kind of a thing. Frisco's the market that company is going to start in nationally. And I think that given that a lot of people, even if they want to work in larger economic centers where they can make more money, no one likes to live with thin walls where they can hear their neighbor, right? I had to live in apartments and townhomes for a long time. Lived in trailer houses where the walls are super thin on that, but those were usually out in the country. But people like their space, and people like to be able to do the things that they want to do without being restricted by other people's thoughts about what they're doing, right? So we followed that, and we looked at it and we considered it. And then we considered, well, what's going on with new permits for housing and new large developments in housing, single family housing, self-storage, multifamily, like what's going on here? So at the same time we were buying this one property, there were a lot of newer properties being built and developed. Sherman High School, the larger city in kind of our MSA, was undergoing a bond to build a massive new school. I like to talk about schools a lot because for any of y'all familiar with Salina, I don't know where y'all are from or what state you're in. If you're familiar with Salina, on Preston Road 289, I've been here all my life outside of traveling for 15 years for the military, whatever. But I'm from the area. And so Salina was always this very tiny town. And when they built their new high school on 289, everyone looked around and was like, what are these people doing? What are they doing? They built this college-looking thing up on this hill. It's massive and nice. Who are they building that for? Well, the state follows growth and the state follows trend and population needs probably better than most, right? And schools do a great job of acting as an indicator for y'all to rely on as far as what kind of growth an area is getting ready for. The schools have to be there in order for the population to come, right? All of us have kids, we have jobs, and we don't want to pay for private daycare. So public schools are the next best thing. I'm kidding. But spoken like a guy who used to homeschool kids, right? But schools offer a great window into what the state and what the county and what the tax dollars are betting on as far as population growth. And so there were a lot of new schools being built all up and down from the Dallas metro all the way north into a lot of these markets. In addition, you had a lot of infrastructure development for sewer and water going on. And so all to say, there's a massive private or public investment into what would be needed for the private sector to grow. Well, outside of that, so you have to find markets that have opportunity for corporate growth. We have, I don't know what the jobs are right now. I'd be lying to you if I quoted something, but we had a market where there were some large corporate employers, MEMC, which is now kind of gone, TI, Caterpillar, Ruiz Foods. The school systems were a big kind of a public sector employment as well. But we had a market where there was a lot of geography for corporation to expand. They had better affordability metrics and fundamentals for their workers to participate in, right? If a corporation wants to grow and they have to have all of their employees be able to afford the Dallas Metro single family housing, then how fast can they grow? They can only pay a certain wage, right? And so corporations were beginning to look for places where they could grow outside of these high cost areas that would still have very high quality of living standard, right? Where the people then that they're paying 70, 80, 100, 120,000 a year could live in a very kind of enjoyable, not financially strapped lifestyle. And so if you've followed this market at all, maybe you know, maybe you don't, but we have three companies that really led the way on this. About 3 years ago, they announced, and it was really pretty neat to see. But Texas Instruments, Globotech, and Z, which is a subsidiary of Apple, they all make advanced semiconductor wafers, right? If you know anything about global economics, all of the issues with Taiwan and China, one of the big problems or worries is 90% of the world's advanced semiconductor wafers are made in Taiwan. Well, I guess the overall thought is that China is going to eventually want to take Taiwan back, which historically had been a part of China proper, if you will. And what happens with the world's ability to outsource or to source advanced semiconductors? Well, the CHIPS Act was introduced about 2 years ago, and that was basically, I think, $80 billion that was brought on to incentivize a lot of the companies to begin manufacturing domestically these advanced semiconductor wafers. Well, Texas Instruments, Globotech, and Z, between the three of them, you have over $40 billion of investment coming to my podunk MSA. I already told you, it's very small. It's an MSA of around 130,000 total people, right? The largest investment into Texas manufacturing occurred here, and it's still being built out right now with Texas Instruments, close to a $30 billion expansion of their facility. And so you have a market that's emerging for a lot of reasons. You have people being driven to it from all over the place, with people coming in from the Northwest, the Northeast, like a lot of these central hubs where affordability has become a challenge for them. They're looking for a different lifestyle. They don't have to be forced to wear a mask if they don't want to, kind of a thing. But outside of that, you had opportunity with new job growth. So in a market, when a new job's created, you can almost bet that 3 to 4 additional jobs will be created for that job, right? Your cooks, your bakers, your candlestick makers, all of the people that supply the locals in that market with the things that they need. Because most markets, I think most goods for most markets outside of like the way Amazon's working these days, but a lot of goods come from within 100, 120 mile radius of the people consuming those goods, right? Especially your perishable type things. And so when you find a market that has job and population growth that's booming, you can completely rely on the fact that those people are going to need housing. They're going to need a place to live. They're going to need a place to store their stuff. They're going to want good restaurants to eat at, different types of restaurants, maybe a wine bar, right? Shoe store, these types of things. And so when jobs and population come into the market, in my opinion, that's probably the biggest precursor that lets you know, yes, I can bet on this. It's going to be reliable. And so I looked for markets where there was that occurring, right? Where are the jobs going? Where are the corporations going? Where are the people wanting to go to? What's the general climate of, if you've got 5,000 friends on Facebook, where do most of those friends want to live? You can kind of estimate what the trend of people are if you have an eclectic, enough friend group on even social media, and ask them questions, right? I found that people like to gravitate towards homes that were similar to the places that they grew up or whatever they identify in their history as a home, right? And most people didn't grow up in these massive urban centers, even though they lived there for points and periods of time. They go to those places because the employment's good. They can make great wages. They can save money for retirement. They can advance their financial future by working in these markets where the pay is higher. So if you can find a market that's small or a market that's growing because there are new jobs coming and population growth is already occurring, there's some other things that you need to look at. What's the supply of housing in that market look like? What's the ability of the city to expand housing in those markets look like? Are they prepared with sewer, with water treatment, all of those things? They have the roads that are going to allow people to come in and support all of that additional movement, right? And so that was pretty neat. And for me, it all started with that first apartment. But right after we bought that, I moved to Colorado, and I live between, if you're familiar with Colorado, Denver's like here, Colorado Springs like here. I live like right over here in this tiny town called Franktown. Sorry. Well, Franktown was situated in a way where it wasn't difficult to see that as soon as the Denver market started growing, and there was already corporate expansion going on by the time that I got there, but they hadn't hired all their employees out. But as the market grew, people would be displaced and they would need more housing. Well, we were situated in an area within that market. So you have your market and then you have a location within a specific market. We looked to buy in a location in the market that was a little bit out removed from everything else, but all of the houses were on large estately style properties. And so we bought a short sale for 332 grand. And it was jacked up. It needed a lot of work. It needed a lot of rehab. But all of the houses around it at the time were selling for 600, 650. And this is 2012, mid to end of 2012. And so I thought, man, if I just figure out how to buy this house and fix the holes in it, paint it maybe, make it look a little nicer, it'll be the fastest way I get 100 grand in my bank account. For me, 100 grand in the bank account was a farce. None of my family had 100 grand in the bank account, right? Well, I was wrong. We sold that house for 5 years, 5.5 years later for $810,000. It made a lot more than 100 grand. But I was right about the fundamentals of growth of the market. And while I was there, I got to see what happened when Denver expanded and they had all their jobs and they hit their affordability caps. I got to see the market growth go from Denver to Colorado Springs. And if you're familiar with that, it's pretty neat. It's the big one does its jam, and when it gets tired, the little one jams back, and it jams back in a percentage-based way that's incredible. And so I got to watch Colorado Springs go through the first, I would say, 3 years of it, kind of its emergent process. And I got to see what happened to real estate values, whether they were residential or commercial, right? I got to see the growth that was occurring in those places. And I realized even then, the quarters of growth that were there, the infrastructure development, the state investment into those things, all of it plays, and it's all very predictable into this pattern, right? If you've ever seen a herd of cattle move, and I don't know if y'all have been out into the country with large herds of cattle, but if you watch a herd of, say, 300-400 head of cattle move across a plain, it's not hard to track them. There's a big dust trail. You just watch the dust. Even if they go below a ridge and you can't see them, just watch the dust. Where's the dust going? And so I learned that people and population are somewhat similar. If you can understand where they're going, or if you can watch some of the fundamentals, the dust, if you will, about what their movement is causing, it becomes really easy to predict them, cut them off, get ahead of them, and make your investment bets there. All of the investing I've ever done in real estate have all revolved around emergent real estate market theory. You want to be ahead of the curve, right? If you were investing into Detroit 10 years ago, awesome. If you were investing into Detroit residential real estate 30 years ago, not so awesome. Why? Well, not because you would have lost massively, but you would have had to wait out a period of about 20 years before it started to emerge again. I'm not sure what markets all of y'all are. Are y'all in Texas? Where are y'all at? If you don't mind, type where you're at. Delorian, I appreciate you say you're investing into single family and moving into multifamily. Edward, you're in Dallas, so you're familiar with some of the stuff I'm talking about, maybe with Sherman Dennison, like Texoma up here, certainly Solana. Dorian, you're in DFW as well. Tampa's a fun market. Florida's got all kinds of emerging things going on around it. My partner in our mortgage business is at Port St. Lucie down there, and that's an emerging market right now and has been for a little while. Sunbelt region, Always. I don't know where Always is. Oh, awesome. Sorry. Got me. So when you start to think of emergent market, just think of trends of people. What are people doing in masses? Well, the general trend I told you all across the nation for the first time in our history has been to leave these large urban centers on the coast and to migrate to the south, at the central south, right? Florida, Texas, Georgia's gone through a really cool kind of emergent process. Phoenix, yeah, that's another market. Was one of the markets we were following for a while. Housing just did some stupid things there because the state was after and aggressive with kind of the iBuyer process and some of the things they were doing with digital values, but still a strong market and has been for a while. But you have a general trend of people looking to leave large urban centers with high taxation and a lot of controls on what they're able to do with their liberty in favor of these other places that aren't as large, that have working opportunity, right? And what's at the same time, what do you have going on with corporations in some of these markets? How many corporations have left California in the last 12 months? Do y'all know? A lot.
No, but
And
it's
some
a
really
lot.
big ones. Yeah. Well, you know why, right? Y'all, are any of y'all small business owners? It's a lot better for me if I employ a person who lives in a town with an average income of 25 grand than if I have to employ that person living in a town of an average income of 100 grand. If I'm employing them in the town of 100 grand, I have to make a lot of money to make sure that their existence is okay so that they'll stay with me. Corporations are no different. So corporations are wanting to find places where their employees can grow and expand. And in the age of remote work like we're in right now, it's kind of all up in the air. If you have a remote work job where you can keep your 6-figure income and move anywhere you want, have any of y'all ever been on vacation to Taiwan or the Philippines? Seen some of those movies where it's like, oh, a shiny dime, I buy your whole hotel, right? Like if you can get into these markets that are fundamentally out of balance with a lot of the bigger markets people come from, you can move from a large market where you sell your average house for 600 grand and you have 200-300 in equity in it, and you have a 6-figure job, and you can move to a podunk area or an area that's up and coming. And now the cash you had from your sale of your home will cover the entirety of the cost of a nicer house in this new market. Why wouldn't you do that? If you have the ability to move wherever you want to go, your work's taken care of, and all you have to find is a place that has the right shopping areas and the food places, or maybe the politics, if that's what you're really chasing. I don't think a lot of people chase politics, but maybe to some degree. But people look for the things that they desire, right? We all do. We want to move to the places that are like what we want to encounter, right? And fundamentally, financial like wherewithal is something that restricts all of us. And so if you can find the places where people are moving to, if you can watch some of the fundamentals that prove that they're moving there, that allow for you to understand, hey, in this area, there have been X number of permits issued, but there's been X number of population moved in, and you see a balance for an imbalance rather of a lot of people moving in and not a lot of new housing permits being issued, right? Well, maybe that's a great market to target with multifamily. And that's what happened in the market that we're in today. And that's why our door rent rates rose rapidly, was because there weren't enough approved areas where home builders were investing in large enough scale to encounter the population that was moving here. And so multifamily blew up, and it's been blowing up here for a while. Single families going nuts now. We're just about the phase where some national home builders are coming in, buying up very large acreage properties to put in these master built communities that have been approved for decades, right? But it's at that pivotal point to where the time that you have to invest, by the time you notice what an emergent market is really happening or looking like, you don't have that long, maybe a year or two. Because after a year or two, everybody's looking at it. Think Dallas apartments, 2012, 13. How many of y'all were shopping for apartments in Dallas in 2012? Probably everybody that was investing into apartments, right? It was all the rage. And so an emergent market is not a hot market. A hot market is a later stage of emergence when people are already aware of all of the growth that's going on. A lot of people have capitalized on it already, and there's less opportunity there. You're going to have to pay a lot higher prices. There's going to be less properties because there's a lot more competition, right? And so if you can get just ahead of that hot market to the emergent stage and bet on it before other people do by following these fundamentals, then your investment's going to be in a much better situation. I'm curious. I don't want to just ramble this whole time. I do want to encounter some questions. I know the Dallas market. I know the Colorado market. Vaguely know the Phoenix, Scottsdale, kind of that market. Followed Atlanta, Georgia market. But what questions do y'all have about some of the things that you can look at to see whether or not a market's growing? I'm going to keep talking until I see a couple questions pop up, just so it doesn't go flat. But for me,
yes, I'll say you're welcome to unmute yourself or raise your virtual hand or post in the chat. Chris is inviting you to ask him questions, so please feel free and go ahead, ask questions as you have them. And Chris, go ahead, keep moving. You're doing great.
I was telling her the house that y'all see me in today. This is everyone has a cool story. For my story began 1,200 yards over there. The two houses I grew up in, 1,200 yards over there. And the house I live in today, I watched this house get built. And I thought, oh my God, what do people do to build a house like that? Right. And my dad built these kinds of houses. Well, when we were moving back to this market after we left Colorado in 2018, this market was still not emerging. It wasn't growing at that point. A lot of the higher end properties people were selling for cents on the dollar. Absorption rates. I'll get right back to that after I get through this. But the house that I'm in now, the house that I watched get built when I was a kid, I had it listed for $899. And for giggles, I went in and threw a $700,000 offer in, and they came back at $750. And I countered with $750 and $8,000 in concessions. So we bought this place for $742, a price that was roughly half of what it sold for in 2006. And that's a metric I like to call buying back in time. If you can buy a property where the market's finally rebounded and you're paying less for it than it sold or traded at previously, I call it buying back in time. You can be confident in those markets, if it's growing, that property is going to come back to where it was, and it's going to go a lot further than that, right? So we bought this place for $742 about 4 years ago, and today I could list it for about $1.5 million, and it's done. Look at the office. This place is still stupid. I'm still uncomfortable bringing some of my friends and family over that knew me from back in the day because I don't want them to get it twisted. I didn't buy this house because I wanted them to see the fancy 8,000 square foot or the 100,000 gallon pool or any of that. I bought this house because I knew it would make $500,000 in 5 years. And I can do that tax-free because I'm married, right? And so it was a market-based capitalization where I knew the market was going to be going through growth period. And I found a property that was being sold less than what it was really worth, certainly less than what it would cost to rebuild. And we pulled the trigger on it. And here in another year or so, we'll probably sell. My guess is we're going to sell for 1.6, 1.75, somewhere in there. Market absorption rates, very important to follow. If you're buying in a market where, let's say you've found a market that has some moderate population growth and there's been some moderate job growth, but builders are going gangbusters in and they're building. And that's why I said, look at the permits being issued versus the population growth coming in. If there are more permits issued and they're building more houses, even the people are coming in, then that absorption rate is going to struggle a little bit. What you want to find is a market where there's not enough supply for the demand that's encountering it, because that's where you're really going to find some rapid growth and emergence in property values and needs and demand, right? And so following what all of your cities have various economic development corporations, economic development corporation. Sherman's has Setco, Sherman Economic Development Corporation. Pottsboro, a town of 2,000 people, has an economic development corporation, but they don't do a very good job, right? And these corporations are pivotal in inviting or attracting or lobbying for corporations to come in with jobs, for population, for work, for the different types of restaurant, that are going to be coming in. And you can go to the city's master plan and you can kind of see what avenues of growth they've already laid out. You can see what areas are pre-approved for large scale housing. You can see what the population demand is, what the work growth and the new jobs announced are. And you can almost bet, like if like here in Sherman, between TI, Globotech, and Z, there's some like 8,000 jobs being announced. There's not 8,000 new houses being built. Yeah. And so when I look at absorption, I think, well, they're going to absorb all of it, right? Because again, it's not just those new people coming in for the jobs or the people here getting those jobs. It's the other jobs that come into a market because of a new job being announced. So if you have 1,000 new jobs being announced with a corporate expansion or a new corporation coming in, bet on 3,000 to 4,000 new jobs coming into that market, 3,000 to 4,000 new people coming in. Look at the houses being built. Look at the existing supply of homes, which is really important right now. Luckily, if you're into single family, there is a huge shortfall of housing nationally right now. And outside of markets that are losing populations, that are losing corporations like California and some of those bigger urban centers out there, most markets are set up to be in a great position over the next decade. Look at the demographics coming in. The millennials were the largest buyers of homes, right? The largest demographic of home buyers in the last several decades, or like ever, actually, is a statement that's true. The Zennials, yeah. Whatever the generation is right behind them, but before Alpha. I don't know how Alpha, they got their name, whatever. They shouldn't be Alpha. But the Zennials are nearly as large as the millennials were. And the Zennials are arguably better prepared for home buying than the millennials were too. And if you look at the demographics, typically people buy homes between 28 and 32 for the first time. Well, the millennials kind of treaded all the way over to the edge of that into their 30s because of some of the obstacles they had, whether it was student loan debt or emotional fears because of what they experienced, what they saw their parents experience during 2008, right? And so they were a little slow to the gun, but are the largest group of home buyers today. Well, the demographics right behind them, the Zennials, are 6-7 million people smaller than them, just about the same size as the boomers, larger than pop generation X, right? And so you have another strong demographic wave that'll be coming online in 5 to 10 years, right? Well, if housing supply is down nationally and demographics support another population group coming online that's just as large as the last one, what of your markets are experiencing inventory increases like crazy right now? Do any of y'all live in a market where housing inventory is just skyrocketing? I bet not.
Chris, I want to
like
step
LA.
in. I want to step in and review a couple of your points on the indicators, right? So you mentioned building permits. That's a good leading indicator in schools. Large schools being built is another indicator. Are those the two main indicators that are good
Corridor
across
growth,
markets?
like roads are a big one. So housing
Okay.
permits, schools, you want to see infrastructure investment. If your cities aren't investing into sewer, into water treatment, into these things, they're not going to be able to handle a large population increase. And so likely it'll go elsewhere, maybe somewhere close, but it matters when you pick out your exact location in a market that you're going to try to exploit for growth, right? But corridors for travel. This is a big one. You have to have roads for people to get to and from the marketplaces, to and from their jobs, if it's going to be expanding. So what does the state infrastructure and the city infrastructure plan for road growth look like, right? That's the big one for me to follow.
So where we can find the city future planning?
Yeah, so each of your cities has a city master plan. You can go on to your cities or your county even websites, and you can type in your city or your county master plan and just into Google. And with a few clicks, you can get to the actual city master plan. This is the plan that they already have for growth. It's where new developments or where zoning kind of distribution occurs, where what their green space or public work plans, all of those things are announced well in advance. It's just not a lot of people look at them.
That's great information. I know the market you're talking about north of Dallas, like I-75 north. There, I counted that Texas Instrument construction. As I was driving through, I counted 14 tower cranes. Well, tower cranes and other cranes all on that one spot where they're building that, $30 billion, construction site.
Yeah.
So that's
the city's building. So we live on Lake Texoma, is a lake with about 650, 700 miles of shoreline, depending on what the elevation is. So tons of water. We ship out water to Dallas even. Well, the city is constructing a lake over there and had already started constructing before they announced the expansion of these facilities. So it was a great indicator, right? Because these facilities need large amounts of water really close on hand in order to operate their machines and all these other things, right? And so you're right. The towers, as you drive by 75 and you look over there to the west for the TI expansion, it's crazy, right? Especially if you're from the market that I am in, because you've never seen that many tower cranes in one place is building anything in this market.
Yeah, did you say Uber Air is coming in with the airlift Uber?
Yeah, that's headquartered out of Frisco. Uber Elevate. Wow.
And they are also building a lot of apartment close to that TI.
They are. So Sherman's been, I knew some guys developing apartments over off 1417, which is the same road that they built the new high school on. And it's just north of the TI facility, maybe 2-3 miles as a crow flies kind of but even with that TI facility, you could see the precursors for that because Sherman had invested in Progress Park, right? 1 and 2, these massive amounts of acreages with fiber optics, with water, with septic, with sewer. They put in so much infrastructure to support corporation growth in those locations. Sunny D was already headquartered. Sunny Delight, I don't know if y'all know it. I know it. They were already headquartered out of there as well as a few other companies. but it's this whole Progress Park, this whole area that the city has zoned, dedicated, and prepared the way for corporations looking to expand or grow or change markets to come into and capitalize with all of the things that they need. And that was started, Progress Park 1 and 2 were started over a decade ago, right?
Anyone else with questions, please raise your hand or come off of mute or type them in the chat here before we wrap up. Get just a few more minutes here, and then Jared will be posting our spinning wheel to choose one lucky winner tonight for a Starbucks gift card. So please type your questions in, come off mute, ask questions. We open it up now for anyone to ask any questions around apartment investing and emerging markets.
Hey, Chris, I have a question. So do you think Dallas will still keep growing?
I do. So I think Dallas is a great market to still be investing in. I would be cautious on what I'm paying in the exact location that I'm investing in. But Texas is one of the states that is gaining advantage from interstate migration from other states. It's a very friendly corporate environment for corporations that want to move here. A lot of population is moving here pretty rapidly, just like Florida and Georgia and a lot of really the southern states. I think Dallas is a fundamentally strong market still, but I don't think it's in an emergent phase necessarily outside of maybe certain locations.
Oh, what are some of the places that you think are emerging in the outskirts of Dallas?
Yeah, so there are a lot of them actually. Y'all remember what Ennis used to look like 10 years ago?
Yeah.
South Dallas,
Oh, no.
East Dallas, West Dallas, which is basically Fort Worth, let's be real. North Dallas, basically in all areas of the metro, there are hot pockets of cities and little locations that are experiencing rapid growth. I think Tarrant County, Tarrant County is the largest by population in Dallas right now. Is that accurate? I think Collin is supposed to be arguably competing with them by population over the next 10 years. For me, the growth out of North Dallas is probably more impressive than any of the other directions because of the quality of growth too, right? You had PJA announce, you've had a lot of these large corporations announce their headquarters there. And with that, it'll bring a lot of attention and a lot of jobs and a lot of need for supportive jobs to come in as well. So I like the North Dallas market. If I was betting in the Dallas market specifically, and I'm looking in single family, I'm looking Salina, Gunner, Dorchester. Dorchester's a little bit further. It's kind of in that middle grounds between Dallas and Sherman, kind of a market up 289. Dorchester just had a massive 600-acre single-family development announced from a national home builder where they're doing this whole planned community with shopping, with some schools, with all kinds of stuff. People are going to go where they can find the things that they want, and I like to be just ahead of it. So that North Dallas growth movement, I really like. South Dallas, again, is still pretty competitive. I think moving out of East Dallas, which traditionally has been a little bit slower, is growing pretty well as well. West Dallas is Fort Worth and Dallas is DFW anyways, right? That's all kind of merge anyways. But even hot pockets within there, like who remembers Oak Cliff 10 years, 20 years ago? What Oak Cliff was like? You driven through there lately? It's different. Las Colinas, like a lot of those markets where traditionally gentrification is a term that triggers some people. I don't know why. It happens everywhere. Like my tiny town of Pottsboro is being gentrified. Only when people get gentrified out of here, they move to mobile home parks with travel trailers, right? But like if you can find a market within or a location within a market that has been run down for a long period of time and the rest of the market's expanded really well, I would bet on those places because where else are the people going to go? Geographically, they're somewhat limited, especially within that epicenter of the market where they want to stay close to the centerfold of it, right? And so those are some of the better places, I think, to bet.
Okay, thank you.
Scott,
Absolutely,
we have
Rita.
a question here in the chat by Scott and Tabitha. Do you feel insurance costs are impacting some markets?
Absolutely. And I think they're going to continue to. I think Florida and Texas and a few of the other states are getting hit pretty hard by like residential home insurance costs. I think they're going to continue to. I think Florida probably worse than even our market. Are you talking Commercial insurance, residential insurance, I mean, it all kind of moves in the same vein, but the reality is a lot of this, as you have home prices elevate, corporation like buildings, commercial buildings elevate, and then you have loss because of wind, hail, tornadoes, whatever, you have a larger value that's hammered and lost from the insurance companies. And so you'll have a higher cost of insurance typically increase somewhat. So I do think that apartment complexes, yeah, I think that you're definitely going to see some of that because the reality is it's going to rob from your profitability on NOI if you're looking to underwrite a deal. If your insurance costs are 3x what they were 2 years ago, or if they become 2 or 3x from where you underwrite it at, I would tell everybody to anticipate insurance increases regardless of whether they're looking residential or commercial, apartment stores, whatever, because of the way values are increasing rapidly, partly because of inflation, partly because of demand, right? But insurance companies have to prepare the way to be able to provide the losses that are likely to occur eventually, given some of the inclement weather things that we face.
Agreed. It's a really difficult time to the underwriting because the insurance is increasing and the interest rate is increasing.
Yeah, so look in a different market. I've been betting on Oklahoma now for about 5 years. I'm investing all over Oklahoma, land and cattle, single family, multifamily, businesses. I'm building a slaughterhouse right now. We've got an RV park going just after that because eventually the growth has to get there. And even if I'm 5-10 years ahead of where the growth will be reaching out to, eventually it has to get there. And I can still acquire properties at a cost where I can cash flow from day one on those.
Good, man. We need to find out where you are going.
You're
I'm
on
going to
social
where
medias, right?
the best time to invest into real estate is when everybody else thinks it's a dumb idea.
Yeah.
Right?
Yeah.
Everyone's focused on Texas. So I'm looking at Oklahoma because we're right here close to it. The Oklahoma border is an hour and a half from the DFW market. There are a lot of fundamentals of growth going on in southern Oklahoma right now that are impressive. You've had a stagnation of value in Oklahoma for a long period of time where it's just lagged greatly behind markets like Texas or certainly DFW. And so as corporations come in, as entertainment, a lot of y'all familiar with Choctaw casinos up here? Choctaw on 75, Windstor on 35. There's a new casino being built over by where we're building an RV park in a tiny town called Kingston. They have owned 40 acres right on the lake. So imagine if people are wanting to come up to visit a casino, you can go to Choctaw on 75. You can go to Windstar on 35, big, impressive facilities, or you can go to Chickasaw with 40 acres on Lake Texoma and a whole water park. It's a $4 billion development that they're working on over there that the state's behind also. And so if you can go to a place that has a little bit more desirable things for you to do while you're there outside of just gamble and check out some of the things, my bet is that's where people eventually are going to go. So we're building a lot in that area.
All righty. Well, if there's no other questions, we're going to pull this lucky spinning wheel and see who wins the Starbucks gift card today. Can you all see the wheel? It's spinning now. Can you see it? Oh.
Good for her. She asked questions, so.
Awesome. Arita, look at you go. All righty.
Hey.
You'll be receiving that Starbucks gift card within the hour by email. And you just take your email, your phone, just open it up into Starbucks and let them scan it and buy your drink.
Oh, okay.
So,
thank you.
There we go. All righty. Well, this was a very great session. Thank you, Chris, so much for sharing that valuable information. I think it'll help a lot of us get better at identifying the markets that we're looking for to invest in. So thank you so much, Chris. And
thank you for having me on. Honestly, Herb, thank you all for attending and checking it out. Please, please, please go out and buy this book. It's cheap. You can get it on Amazon. Emerging Real Estate Markets by David Lindahl. Read that book. It speaks from an investor perspective, and it's going to help you understand a lot of these fundamentals and what to watch for much better than I can.
Oh yeah, I know him. David
Thank
Lindahl.
you.
He's a good, very good in the real estate.
Yeah.
Okay, all right, guys. Thank you
Alrighty.
very much, everyone. Bye.
Well, see y'all next week.
Bye.
Bye.